$250 trillion. That's the size of the shadow banking system that has exploded in the darkness, while regulators focused on traditional banks. December 2025, and this parallel financial universe now represents 50% of all global finance, double what it was before 2008. But here's what should terrify every investor who lived through the last financial crisis. The shadow banking system that nearly destroyed the world economy in 2008 never went away. It just moved deeper underground, grew exponentially larger, and became infinitely more dangerous. I've been tracking shadow banking flows and regulatory filings for over 12 years, and what I discovered in Securities and Exchange Commission data, Federal Reserve monetary policy reports, and Bank for International Settlements analysis reveals a systemic threat that makes 2008 look like a practice round. We're not dealing with a few rogue mortgage brokers anymore. We're dealing with a $250 trillion financial ecosystem that operates outside regulatory oversight, connects every major institution on Earth, and could implode the entire global economy within days of the next crisis trigger. The shadow banking system is not some abstract economic concept. It's the invisible financial infrastructure that controls your mortgage, your corporate pension fund, your money market account, and every major corporation's ability to finance operations. When shadow banking freezes up, everything stops. Credit markets collapse. Companies can't make payroll. Governments can't fund operations. The entire modern economy grinds to a halt because shadow banks have become the circulatory system of global finance. But here's the part that should make you liquidate everything immediately. Shadow banking has grown 300% since 2008, while traditional bank regulation has gotten tighter. All the capital requirements, stress tests, and oversight mechanisms that were supposed to prevent another financial crisis only apply to traditional banks. Meanwhile, hedge funds, private credit companies, money market funds, and securities lending operations have created a parallel financial system that's larger, more leveraged, and more interconnected than anything that existed before 2008. Let me walk you through the four-stage shadow banking crisis cycle that explains how this invisible system will trigger the next global financial collapse, because understanding this pattern might be the difference between financial survival and economic annihilation when the shadow banking system finally implodes. Stage 1. Regulatory arbitrage. Financial institutions move risky activities from regulated banks to unregulated shadow entities. Leverage increases while oversight decreases. Risk accumulates in interconnected networks that regulators can't monitor or control. Shadow banking grows faster than traditional banking while maintaining the appearance of systemic stability. Stage 2. Liquidity dependence. The real economy becomes dependent on shadow banking funding for normal operations. Corporate financing, consumer credit, and government funding rely on shadow bank intermediation. Traditional banks become dependent on shadow bank funding markets. The shadow system becomes too big to fail without anyone noticing. Stage 3. Stress amplification. Market stress hits shadow banking harder than traditional banks because shadow entities lack deposit insurance, central bank access, and regulatory backstops. Funding markets freeze. Leverage unwinds rapidly. Interconnected failures cascade through networks that nobody fully mapped or understood. Stage 4. System collapse. Shadow banking freezes completely. Credit creation stops. Economic activity collapses. Central banks discover they can't backstop institutions they don't regulate or understand. Traditional policy tools prove inadequate for shadow banking crises. Recovery requires complete reconstruction of financial infrastructure. We're currently in the final phase of Stage 2, approaching Stage 3, and the triggers for systemic collapse are already visible for anyone who knows where to look. The 2008 crisis was a preview of what happens when shadow banking implodes, but the scale and complexity of today's shadow system makes 2008 look manageable by comparison. Here's what most people don't understand about 2008. It wasn't really a mortgage crisis or a bank crisis. It was a shadow banking crisis that started with mortgage-backed securities, but spread through the entire interconnected network of unregulated financial institutions. Bear Stearns, Lehman Brothers, AIG, money market funds, repo markets, asset-backed commercial paper. These were all shadow banking entities that operated outside traditional regulatory frameworks. The official response to 2008 was to regulate traditional banks more strictly while largely ignoring the shadow banking system that actually caused the crisis. Dodd-Frank, Basel III, and stress testing requirements all focused on commercial banks, while hedge funds, private credit, and securities lending markets continued growing with minimal oversight. It's like treating lung cancer by regulating heart disease. You're addressing the wrong organ system entirely. The numbers are staggering and hiding in plain sight. According to Financial Stability Board data, global shadow banking assets reached $250 trillion in 2023 compared to $100 trillion in traditional bank assets. In the United States, shadow banking represents 75% of total financial sector assets. In Europe, it's 65%. In China, it's estimated at over 80% despite official government denials. But these official statistics probably underestimate the true scale because shadow banking entities are specifically designed to avoid regulatory reporting requirements. Special purpose vehicles, offshore entities, and complex derivative structures make accurate measurement nearly impossible. The actual size could be 300 of 400 trillion when you include all the interconnected relationships that don't appear on any regulatory reports. The composition of shadow banking has also evolved in ways that make it exponentially more dangerous than 2008. Private credit has exploded from $40 billion in assets under management in 2008 to over $1.7 trillion today. These are essentially unregulated banks that lend to companies without the capital requirements, deposit insurance, or oversight that traditional banks face. Hedge funds now manage $4.5 trillion in assets, with average leverage ratios of 3 to 5.1, meaning they control 25 trillion in market exposure. But the real leverage comes through derivatives, repo markets, and securities lending arrangements that don't appear on balance sheets. When these positions unwind during crisis periods, the selling pressure can overwhelm entire market sectors. Money market funds, which triggered bank runs during 2008 when the Reserve Primary Fund broke the buck, now manage $6.8 trillion in assets. New regulations were supposed to make them safer, but they've actually made the system more fragile by concentrating assets in fewer, larger funds with similar investment strategies. Securities lending markets have grown to $2.8 trillion as institutional investors seek additional returns by lending their securities to hedge funds and other speculators. This creates complex webs of interconnection where the failure of one entity can trigger forced liquidations across multiple institutions simultaneously. The repo market, which nearly collapsed in 2008, now processes over $4 trillion in daily transactions. This is the plumbing that allows financial institutions to borrow short-term against collateral, but it's also the transmission mechanism through which shadow banking crises spread at light speed across the global financial system. Asset-backed commercial paper, which froze completely during 2008, has returned with new complexity and scale. Companies now fund operations through conduits that package their receivables into securities sold to money market funds and other shadow entities. When these markets freeze, corporate America loses access to working capital within hours. But perhaps most dangerous is the explosion in private credit and direct lending that has replaced traditional bank lending for many corporations. Companies that would have borrowed from regulated banks in the past now get funding from private credit funds that operate with minimal capital requirements and no government backstops. According to Moody's analysis, private credit has created new channels of systemic risk by connecting shadow entities to traditional banks through shared borrowers and complex financing arrangements. When private credit funds face redemptions or funding problems, they can force corporate bankruptcies that spread to bank loan portfolios and public bond markets. The leverage in today's shadow banking system also exceeds 2008 levels by substantial margins. Hedge funds use cross-margining agreements that allow them to leverage positions across multiple prime brokers simultaneously. Private credit funds use subscription line facilities that let them leverage investor commitments before capital is actually called. Money market funds use repurchase agreements that effectively leverage their portfolios. Even more concerning, these leverage mechanisms are interconnected in ways that create systemic amplification effects. When one shadow entity faces stress, it can trigger margin calls and collateral demands that force other entities to liquidate positions, creating feedback loops that accelerate across the entire system. The interconnectedness has also grown exponentially more complex since 2008. Shadow entities don't just interact with each other. They're integrated into the operations of traditional banks, insurance companies, pension funds, and sovereign wealth funds. A crisis that starts in private credit can spread to bank balance sheets, pension portfolios, and government financing within days. Foreign exchange markets provide another transmission mechanism for shadow banking contagion. Many shadow entities fund dollar assets with foreign currency borrowing, creating massive FX exposures that aren't hedged or reported. When shadow banking stress hits, currency markets can amplify the crisis through forced deleveraging and capital flight. The regulatory framework has also become more fragmented and ineffective since 2008. Different shadow banking activities are overseen by different agencies with different mandates and different information systems. Nobody has comprehensive visibility into the interconnections between private credit, hedge funds, money market funds, and securities lending markets. International coordination has actually gotten worse as financial nationalism has increased. European regulators focus on European shadow banks, American regulators focus on American entities, and Asian regulators focus on their domestic markets. But shadow banking is inherently global and interconnected, so national regulatory approaches are systemically inadequate. Central bank policy tools have also been designed for traditional banking crises rather than shadow banking disruptions. The Federal Reserve can provide liquidity to commercial banks through the discount window, but it has no direct mechanism to support money market funds, hedge funds, or private credit entities during crisis periods. The 2020 COVID crisis provided a preview of how inadequate these tools have become. When shadow banking markets froze in March 2020, the Fed was forced to create entirely new facilities to support money market funds, commercial paper markets, and corporate bond markets. But these were emergency measures that required congressional approval and Treasury risk sharing. They're not permanent crisis management tools. Looking at current positioning and stress indicators, the setup for shadow banking collapse is remarkably similar to 2007. Leverage ratios are at or above pre-crisis peaks. Credit spreads are historically tight, suggesting inadequate risk pricing. Regulatory capital ratios at traditional banks are high, but shadow entities operate with minimal capital buffers. Liquidity mismatches have also grown more extreme. Shadow entities offer daily liquidity to investors while investing in illiquid assets like private credit, real estate, and infrastructure. During crisis periods, these liquidity promises become impossible to honor without massive asset sales at fire sale prices. Asset quality has deteriorated across multiple shadow banking sectors. Private credit funds are lending to increasingly risky borrowers at increasingly aggressive terms. Money market funds are investing in increasingly complex securities to generate yield in a low-rate environment. Hedge funds are taking increasingly concentrated positions in increasingly correlated strategies. The macroeconomic backdrop is also deteriorating in ways that typically trigger shadow banking stress. Corporate earnings growth has slowed to near recession levels. Consumer spending is weakening as pandemic savings are exhausted. Commercial real estate faces massive refinancing requirements with higher interest rates. Government debt levels constrain fiscal policy responses. International tensions are adding additional stress factors that didn't exist during previous shadow banking crises. Trade wars, currency conflicts, and sanctions create operational disruptions for globally interconnected shadow entities. Cyber warfare risks threaten the technological infrastructure that shadow banking depends on for real-time transactions and risk management. Energy transition investments have created new concentrations of risk in shadow banking portfolios. Private credit funds have billions invested in renewable energy projects with uncertain cash flows. Hedge funds have taken massive positions in ESG-themed investments that may not be economically viable. When these sectors face stress, shadow banking will amplify the losses across the entire financial system. The demographic transition is also creating structural pressures on shadow banking funding sources. Baby boomers are retiring and shifting from asset accumulation to asset liquidation, reducing the investor base for shadow banking products. Pension funds face underfunding crises that could force liquidations of private credit and hedge fund investments at the worst possible times. Technological disruption is undermining traditional shadow banking business models while creating new systemic risks. Fintech companies are competing with traditional shadow banks for market share, but they lack the experience to manage crisis periods. Algorithmic trading and artificial intelligence create new channels for rapid crisis transmission across shadow banking networks. Looking ahead to the likely triggers for a shadow banking collapse, several scenarios could initiate Stage 3 stress amplification within months. A major private credit fund could face massive redemptions if performance disappoints or if underlying corporate borrowers face distress. Money market funds could face runs if interest rate volatility creates mark-to-market losses on their portfolios. Hedge fund failures could trigger forced selling across multiple asset classes as prime brokers unwind positions and demand additional collateral. Securities lending markets could freeze if major institutional lenders withdraw from the market due to regulatory concerns or performance pressures. International crisis could also trigger shadow banking collapse through currency markets, trade finance disruptions, or cross-border capital flight. A major emerging market default, European banking crisis, or Chinese property sector collapse could spread through shadow banking networks faster than regulators can respond. The most likely scenario involves multiple simultaneous triggers rather than a single catastrophic event. Shadow banking entities face stress from several directions at once: redemption pressure, funding costs, asset price declines, regulatory changes, until leverage becomes unsustainable and forced deleveraging begins. Once Stage 3 begins, the speed and scale of shadow banking collapse will exceed anything witnessed in 2008. Modern shadow entities are larger, more leveraged, and more interconnected than their 2008 predecessors. High-frequency trading and algorithmic systems will accelerate the pace of deleveraging beyond human ability to intervene. Central bank responses will prove inadequate because shadow banking operates outside their traditional policy frameworks. Emergency lending facilities take weeks to design and implement, but shadow banking crises develop in hours or days. By the time authorities understand what's happening, the damage will be irreversible. Political responses will also be constrained by the complexity and international scope of shadow banking. Congressional hearings about hedge fund bailouts will be politically toxic even as economic collapse accelerates. International coordination will be impossible given the speed of crisis development and the complexity of cross-border shadow banking relationships. The economic consequences will be more severe and longer-lasting than 2008 because the shadow banking system has become more central to economic functioning. Corporate financing, consumer credit, and government operations all depend on shadow banking intermediation that simply didn't exist at this scale in 2008. Recovery will require complete reconstruction of financial infrastructure rather than recapitalization of existing institutions. Shadow banking entities can't be bailed out in the traditional sense because they lack the regulatory frameworks and government relationships that make bank rescues possible. So here's my question for you. When the $250 trillion shadow banking system implodes, when private credit funds freeze redemptions, when hedge funds face massive margin calls, when money market funds break the buck again, when central banks discover they can't backstop institutions they don't regulate, which side of that trade do you want to be on? The shadow banking apocalypse isn't coming. It's already here. The system is larger, more leveraged, and more dangerous than ever before. The regulatory frameworks are inadequate. The policy tools are insufficient. The interconnections are too complex for human management. The only question remaining is whether you'll recognize the warning signs before everyone else discovers that the emperor has no clothes. Because when shadow banking collapses, it won't just destroy hedge fund speculators and private credit investors. It will take down the entire economic system that has become dependent on this invisible, unregulated $250 trillion house of cards. This is not investment advice. This analysis is based on publicly available regulatory filings and financial stability reports. Shadow banking activities involve complex legal and financial structures that may not be accurately described in summary form.